Campbell's. All right, this is a value stock. This is a consumer staple stock. Um, these guys have been around forever, and it's a consumer staple. $12.4 billion market cap, revenue $9.9 billion, PE 22, forward PE 13. What's it done for a year? It's performed poorly. It's down 2.7, while the rest of the market was up big time. The S&P was down up 25%. The NASDAQ was up 33%. So stocks like these are easy to understand. I mean, as a boy, and even I've got kids, so yeah, we got Campbell products and we've eaten them, and it's easy to understand the company. But it's one thing to recognize a brand, but it's more important to recognize where there's value. And companies like these are not great investments. Retail investors like owning these because they understand them and they get lured by that dividend. Oh, but it has a 3.7% dividend. Yeah, but once you see the loss that you had for the year, you barely made 1%. Meanwhile, most stocks in the S&P were up 20%. So you fell way behind. And over the last 5 years, the NASDAQ has more than doubled. The S&P has doubled in value. Meanwhile, you can add up this dividend, and over 5 years, maybe you're up 18% on the dividend. You minus this 14.5. So you made 3%, while the rest of the market doubled their investment. So if you put $10,000 in Campbell soup 5 years ago, you'd be like, well, this sucks. I got less than $10,000 today. If I would have put it in the S&P on an ETF, I would have doubled that money, and I would have $20,000 in 5 years. If I would have put it in a NASDAQ ETF, I'd have more like $22,000, $23,000. And that's why I don't touch many stocks that are consumer staples. Consumer staple stocks I'd rather go into a bond. If you really like dividends, bonds pay a better dividend, and they hold their value as opposed to this one losing value. So I don't like consumer staples because what I hope is people that come to my channel, you're looking to grow your knowledge. You're looking to be a better investor, a more advanced investor. And I'm going to be consistent in the fact that, I would not, especially for a younger investor under 40, I would not like to see investors invest in this category, because you're going to fall way behind. It's better to take a chance and buy a selection of stocks. They're growth stocks. A couple of them are going to be winners. You're probably going to have a loser or two, but then the winners are just going to do so well. Like Robinhood, in 1 year up 200%. Well, that grows pretty nice, right? You put that 10 grand in, a year later, it's worth 30 grand. That's what I'm talking about. So I stay away from consumer staples. And on this one here, this company is growing. But when we look at the other fundamentals, like what's their gross profit all about? Gross margin is pretty good, 31%. And free cash flow is good. This is a value stock. But as I showed you from the appreciation, even though these guys are operated really well, their employees work really hard, it's just a really old business that's undesirable. So I don't invest in these. And the evidence of why is here. This is what they do. I'd rather see somebody try to find the next stock that looks more like this, up 54%, up, over the last 2 years is more than doubled in value. Even though it's a risky stock, even though it's kind of an unusual industry, this has grown to be worth more than Campbell Soup, even though they don't have anywhere near the revenue that Campbell Soup has. That's a lot of soup cans. Double the revenue. It's worth $12 billion. Half as much revenue, it's worth $66 billion. It's growth, it's industry, it's buying in the right industry, it's buying the right growth companies.